Welcome students. So now we will learn about, as a next step in the cash flow estimation, we will learn about that practically how financial institutions define the cash flows. And in this process also there is not a big difference that how financial institutions define cash flows, because we have to be concerned about the financial institutions part also, because we are going to borrow money from project entrepreneur or project developer, or maybe as an entrepreneur or as a startup owner. If we are going to borrow money from the different financial institutions, so we have to satisfy their requirements also, and we should be very clear about that how financial institutions define the cash flow process, and what is the cash flow for them, or how they would like to see the working of the cash flows or calculations of the cash flows. So this is again a very important concern, and we have to satisfy their concern also. So this is the way how they look at it, and for that purpose they have to again work out the cash outflows, and finally they have to calculate the say operating inflows and the terminal value. So this is basically the cash outflows means investment. When we were talking about the initial investment, this is they will look at, they will like to calculate that how much initial investment would be required and how would that be calculated. So we will take into account the capital expenditure on the project, right. So that they will agree that yes, the capital expenditure on buying land, plant, building would be required, net of interest during the construction period. They will not talk about the interest on during the construction period. They will only talk about the capital expenditure, right. So capital expenditure required during the construction period, and the gross working capital, that is this expenditure required or maybe the funds required on account of the gross working capital, means for building all the current assets. They do not take the net working capital, they take into account the gross working capital, because for the initial projects or at the initial level, and say funds from the current liabilities may not be available. So they only take into consideration the investment part, that how much you are going to invest into inventory, credit sales, prepaid expenses, advance deposits, and how much you want to keep as a cash. So this is the total investment, capital expenditure plus total investment in the current assets, that is called as a gross working capital. This becomes the total cash outflow. And we have seen in the normal course also, in the previous discussion also, or we learned to prepare the cash flow statement for the total funds point of view. There we saw almost the same process, that on the top as a first part, we are taking the initial investment, and the second part is the operating inflow. We are talking about the operating inflow, and for calculating the operating inflow we take into account the profit after tax, or financial institutions also agree with that yes, profit will be there, and that will be the first source of the cash inflow, operating inflow. Into that they will also add the same way as we have been doing the depreciation or the all non-cash expenses, and they will also add back the interest and the lease rentals, if any. They will also be adding it back. So total cash flow they will also work it out. And finally you call it as the recovery of the working capital, and then they will take into account the say residual value of the capital assets. And even if the capital assets are going to depreciate fully, right, they are going to depreciate fully, still there is something called as the scrap value, which they will count as the 5% of the total cost of the fixed assets, and land as a fixed asset would be counted as 100%. So the land value as a terminal value, or on the termination of the project, they will say the land will give us back 100% amount invested. Fixed assets will give us 5% of the face value, or maybe the, say you call it as the initial value, or maybe the book value you call it as, and working capital would be recovered in full. So this will be the terminal value. So inflow will be coming from profit after tax, it will be coming from the depreciation and all non-cash expenses plus interest or any lease rental, and terminal cash flow as we have been doing in the past, that is on account of the working capital and the fixed assets. So this way they calculate, but they, for taking the residual value of the fixed assets or capital assets, they count land as 100% or at the 100% price, and capital assets only at the 5%. They assume that 5% of the book value will be returned back or will be paid back by the fixed assets at the time of the terminal inflow, at the time of the termination of the project. or we are even closing down the venture. So, simple way, simple process by the financial institutions also, 3 steps involved. Number 1 is the capital expenditure, number 2 is the operating inflows, and number 3 is the terminal inflows. So, capital expenditure, normally we have been talking in the past also. Operating inflow, same process, starting with the PAT and then all other say sources of the funds or inflows, and terminal value on account of the fixed assets and the current assets. So, sum total of these three these two, operating cash inflow and terminal inflow, will be the inflow, and investment on the capital expenditure and working capital would be outflow. So, the difference would be the net cash flow. Finally, means we will be calculating the net cash flow from the perspective of the financial institutions, and this will be the net cash flow, where the will be subtracting the total investment or cash outflow from the cash inflow, and the balance left would be giving us the net cash flow that will be available to the debt providers as well as to the equity shareholders, to the financial institutions if the debt is coming from them, and to the equity shareholders, maybe to the promoters. Then we are moving towards now the closing part of the cash flow working out or estimation of the project cash flows. So, here are some important points of caution, and these important points of the caution are in the form of the biases, right? Biases in the cash flow estimation, because many a times we become biased in favor of the cash flows, not against the cash flows. We become myopic, and we become influenced by the something which is called as a myopic euphoria, and we lack the objectivity in estimating the cash flows, and sometime the cash flow maybe the net cash flow worked out is so maybe an optimistic value, and that in the practical sense it may not be possible or it is not going to be there. So, as I told you in the past also, that whatever the business estimates we are going to work out, we always have to bear in mind the convention of conservatism. We have to apply the convention of conservatism, that if we are conservative in our estimates, then we are going to be very successful. But if we are going to be very optimistic and tomorrow the things are not going to happen like that, then there would be a problem, there would be an issue. So, we will have to be very careful about that, whether we are working out the cash flows means by taking these biases in our mind, or we are very optimistic and tomorrow getting caught in the trap that actually the cash flows were not there up to that mark. So, we had misinterpreted the market and demand analysis results also, we had misinterpreted the technical analysis results also, and we have misinterpreted the different sources of the funds, where the funds will be coming from, and the financial cost as well. So, that may create a serious problem, serious issue. So, we have to do away with these biases, and whatever the cash flow we are going to work out, maybe actually they may be more than in the practical sense, in the real life the cash flow may be more than the worked out cash flows, but if it is less than the worked out cash flows, then it would be a serious problem. So, we have to be careful for these biases or about these biases, and we have whatever we are going to work out, that has to be truly based upon the facts. So, there are the different kind of the points of optimism or maybe the biases, and over optimism is something which is very dangerous. We have to be careful about, which may stem from the following important things. So, it means if any over optimism is shown, and we show that we are going to have this much of the net cash balance available at the end of any particular year, or maybe at the end of the total life of the project, and actually it is not going to happen, then it is going to create a serious problem for us. So, these are the different sources from where the over optimism may flow up, and number one is the native optimism, which is maybe inbuilt optimism in the people who are working out the cash flows, maybe who are estimating or interpreting the market and demand analysis results, because that is the source of the cash inflow, and technical analysis results, that is a cause of outflow. So, if you are highly optimistic, so what would you do? You would overemphasize upon the market and demand analysis results, you would overestimate them, and you would underestimate sometime the capital say investment required on account of the fixed assets, or maybe the short term investment required on account of the working capital, and that would be because of the misinterpretation of the technical analysis results. So, native optimism is bad, we have to avoid that and we have not to commit any blunders. Maybe you can work out the cash flows which are going to be say less than the real cash flows, but not in any case more than the real cash flows. So, be careful and avoid the native optimism, and you have to be careful about the attribution error also. Attribution error says that underestimation of the situational factors. If you are not taking into consideration the situational factors, maybe that market and demand analysis, we are not taking into consideration the situational factors. For example, if you talk about that example of Anchor Fruit Beer, so they were overemphasized, means they were overemphasizing the market and demand analysis results, and they were say over optimizing it, that whatever the product we are going to manufacture and bring it in the Indian market, that is going to be a welcome product and people are going to accept it like any other thing. So, they disregarded the situational factors, they disregarded the conditions of Indian market, they disregarded that Indian market is a highly price sensitive market. Here people use the product like a fruit beer for maybe the beer for intoxication purpose. Fruit beer is a non-alcoholic purpose say product. So, whether it would be liked or used by the people or not used by the people. So, we were highly optimistic, not realistic, and the situational factors were ignored at that time, attribution error was committed, and as a result of that project failed. Company lost 350 crores, and finally there could be many reasons for that, but one important bias was the attribution error, because situation was not properly read, was not properly taken care of. Economy, market, people, their liking, taste, acceptance of the products, distribution process, that was not taken into account, and finally what we ended up with was not up to the mark, and the net result was the failure of the project. Next is the anchoring. Anchoring is something more consideration to the internal factors rather than the external environment, and using the irrelevant information. That is very important point, and anchoring is another source of the project bias. So, you have to take into consideration both internal as well as the external factors. While going for the different stages of the project analysis, market and demand analysis always consider the external factors. Internal factors, you can manufacture the product, you have the capability, you have the technology, you have the investment, you have the knowledge of the maybe not this market but other markets, you are established player in the other markets. But what about the external factors which are going to play a very serious role, and you have to look at the people, the potential customers, the say their requirements, their taste, their say income level, distribution system, and you have to use the relevant information, not the irrelevant information. And for example, in the Anchor Fruit Beer project, the relevant information was what is the income level of the people, what is their normal requirement of maybe for having the substitutes of the fruit beer, what normally they use, and are they going to use this fruit beer, or they are going to say misconceive it as a alcoholic beer or not. So, all those external factors when we are not taking into consideration, even in case of the inputs also, you can manufacture, you can convert the raw material into finished product. For that purpose you have got the technology, plant and machinery, but raw material should also be like that. Number one, it should be easily available, and second thing should be, it should be a good quality raw material, and it should be of your maybe standards, expectations. For example, these say you got consumer product companies, when this say fast food companies, when McDonald is say making burgers for us, so they are using some material, or Burger King is making burgers for us or selling burgers in the Indian market, they require the ingredients, and all those ingredients are of the best quality. Sometimes they are not from the local market, they are imported. Say talk about the tomatoes, quality of the tomatoes, talk about the qualities of the potatoes, so talk about the qualities of the onion. All these products, they do not want to use it. So, if they are not easily available in the market, they are external factors, they are going to impact you, and the people may reject your product. So, input and finally converting that into output. So, you might have internal capabilities, but external, maybe the sources of the raw material, maybe the human resources, or maybe the any other inputs, they may not be available up to the mark, and even when the final product goes to the market, people may not like it because of certain not your capabilities, but because of their limitations being an external factor. So, always take into consideration those factors and the relevant information while working out the cash flows, and do not commit the error which is called as anchoring. Myopic euphoria, I have talked to you many a times, that is a basically lack of objectivity. You are always a daydreamer, right? You are always a happy camper or daydreamer. So, do not be a happy camper, do not be a daydreamer. So, myopic euphoria is that when you lack the objectivity, you are not basing your decision upon the facts, you are not basing the decision upon the relevant information, but you are maybe always dreaming of doing everything best. So, that is called as a myopic euphoria, and when you lack objectivity in your decision making, you lead yourself towards the failure, or you lead the project towards the failure, and there is every likelihood that the project will not succeed, investment will not deliver the fruitful results, and finally it may become a big failure also. So, do not get affected by the myopic euphoria, and always be careful that we have to base our decision on the objective decision making, not on any kind of the subjective concerns, or the amount of the subjectivity has to be minimum or almost 0. The total decision has to be based upon the objectivity. Then competitors neglect. When you neglect your competitors in the market, you are going to misinterpret the cash flows, and you are again over optimizing them, and finally you are ending up with a failure. So, that is a very serious concern. Always bear in your mind your competitors are better than you. They are going to have the sizable market share, and if you are not going to work as per maybe their strategy or policy, then you are going to meet with the failure. So, always bear this in mind, that out of the total market, how many players are there in the market and what share of the market we are going to get, right, and convert that into the market and demand analysis. And for manufacturing that much amount of the product, how much investment would be required, talk about that. And stretch the organizational pressure. Many a times there might be a pressure on the people who are working out on the project estimates, that you have to give us the best estimates and optimum estimates. In the wake of working out something optimum, they optimize, or maybe sometimes they over optimize it, right. They become very optimistic and they over optimize it, and when they over optimize it, not based upon the say ground factors or the ground realities, but because of the pressure of the bosses or maybe the superiors, that anyway we have to show it as a successfully working project. Maybe we want to raise the funds from financial institutions, so we want to impress upon them, or maybe we want to prove it to some say the other stakeholders, including shareholders, that whatever the investment we are going to make, that is going to give us the very good cash flows, and we are going to be a successful venture. So, because of that also, because of the organizational pressure also, we sometimes overemphasize on certain things which are not going to happen in the real world. And stretching the targets, right. Setting higher and the more ambitious goals. So, when you stretch the targets, and if you are not able to make it, maybe you make the blunder and finally the projects fail. So, do not stretch the targets. Whatever you can achieve, do that. Fix up the targets and try to work upon that, and be realistic in setting up of your targets. If you are becoming over optimized and it is not based upon the facts, if it is not realistic, then it is going to create a problem. And finally, maybe these all biases are going to be the reason for the failure of the project, and if the sufficient cash flows are not available at the end of every year, or maybe over the life of the project, you cannot pull along unendingly, and finally you have to have the positive net cash flows, maybe not in the beginning of the first year, but not in the beginning, maybe beginning of the first year or end of the first year or end of the second year or end of the third year, but at least after third year you should have the positive cash flows, surpluses available, because finally you have to compare the total, maybe the present value of the cash inflow with the cash outflow, and you have to prove it that NPV of the project is either 0 or positive. Only then we are going to take a decision. But if you are saying that from the first year onwards we are going to have the say a positive net cash flow, and the total net cash flow worked out or the total cash inflow worked out is going to be very high as compared to the cash outflow, and that all estimates are not based upon the facts or the realistic information in the market, then it's going to be a big problem. And finally, the misinterpretation, or say call it as the lack of the proper objective considerations and working out the cash flows on certain things which are not based upon the facts, may lead towards the failure of the projects, failure of the ventures, and finally the total investment may go down in the drain. So, always be careful while estimating the project cash flows, and finally maybe because you have to discount them, you have to calculate the NPV or IRR based upon them. So, it would be better if they are based upon the facts. Now, optimism and tempering the optimism we will discuss as the last part here, and then we will be doing that problem. So, optimism is very important thing, right. So, normally it is written here very clearly, human tendency for optimism is inevitable. Human tendency for optimism is inevitable. Likewise, organizational influences that promise optimism will persist. Likewise, organization influences that promise optimism will persist, yet optimism need to be tempered, means it is a human tendency to be optimistic in the real life, and these cash flows are also being worked out by the human beings. So, when we are highly optimistic, we are going to commit the blunders. So, always temper the optimism and be realistic in the life. If you work out the cash flows on the basis of the realistic estimates, then you would be at a better place. So, how that tempering can be done, how the optimism can be tempered. So, two you call it as the decision making say scientists who worked on the decision making and who have maybe a very good contribution in the process of learning about the decision making process. They are Dan Lovello and Daniel Kahneman, right. So, these two scientists, decision making scientists who have worked a lot on the decision making, they are Dan Lovello and the Daniel Kahneman. So, they suggest that decision makers should use the outside view. They should use the outside view, not the inside view. They should look at the project from the perspective of the others, not from their own perspective. How the people are going to view your output, your project, your venture, the products coming out of it, the services coming out of it, and then you try to evaluate it. And you also see that, for example, if the product from this project coming out tomorrow, if I have to buy it myself, would I like to buy it, or I have to think about it? For example, you think about that fruit beer case. If the promoters of the company had thought about that we are coming to India, we are going to work out in the Indian market, we are going to set up a plant in the Indian market, we are going to manufacture a product like fruit beer in Indian market. So, who are going to be our buyers? You could have put yourself into the shoes of the buyers, and then you could have seen that if I am the buyer, would I like to, if my income is given at this level, if my income is this, I have number of alternative and substitutes who are the substitutes of the fruit beer. So, at this price of 750 ml of the fruit beer, or maybe smaller 200 ml of the fruit beer, if I have to compare it with the alcoholic beer and the price is comparable, so would I go for buying the fruit beer as a potential buyer of this product? So, if you look at from the perspective of outside view, the picture would be more clear, right. The picture would be more clear. So, that is why these two scientists, Lovello and Kahneman, they say that this calls for looking at the outcome of the similar projects or initiatives and using that evidence to inject greater objectivity in forecasting exercise. You compare these the project which you are going to come up with, or you are going to work out the cash flow on, you have to compare the outcome of your venture with the other similar projects or initiatives if they are existing in the market. And if they are not existing in the market, they may be existing in the other countries' markets. So, look at these two different situations, two markets. What is there in the other countries, what is there in India? If we are going to bring the same product which is there in the other countries, how it is going to work it as. And for example, in India, if you are going to have the same product, or maybe you are going to compete with the existing products in the market, what is their level of success, how they are doing it, learn from them, and then you have to become a substitute to them. When Jio came to the Indian market, already 4 players, very good players, large sector players were existing in the market. So when they came out as a 5th player in the market, so they must have analyzed the market from the outside perspective, not from their inside perspective. They knew it, that they have to compete with Airtel, which is a leader in the market. They have to compete with the public sector large sized company BSNL. They have to compete with the multinational company Vodafone. They have to compete with this Birla Group company Idea Mobile Telephones. So they must have analyzed everything. That's why it became a big success, and in a very short span of 9 years, Jio phones became, or mobile telephony became, the second largest company in the country, and it gave a stiff competition to the existing players who were existing in the market before Jio came to the market. So you have to temper the over optimism. So empirical evidence suggests that when the people are asked to take the outside view, their forecasts become more objective and reliable. Means when you take the outside view, their forecast becomes more objective and reliable. So always, means if you want to temper the over optimism, always take a outside view, not the inside view, and finally take the decisions based upon it. You would be taking the right decisions. Further, they say, these two scientists say, that the advantage of outside view is most pronounced for initiatives which have not been attempted earlier, such as entering into a new market or building a plant using a new technology. Means this outside view is more useful for the projects which have not seen the light of the day in any economy or in any particular market, right? Or people have not tried these. There the outside view is going to be very, very useful. Maybe it's a question of entering a new market or building a new plant. Everywhere it will help. Everywhere it would be useful. So finally it is said here, ironically, that the inside view is often preferred in such a case. We normally keep ourselves limited to the inside view and we meet the failure. So we have to always take into consideration when you are entering a new market, you are introducing a new product in the market, right? So you think it from their perspective, from the outside view perspective, not from the inside view perspective. You can manufacture the product, you can generate the service, but is it the market there? Sufficient market is there? Can you sell the product in the market? Are the buyers there in the market? If the buyers are not there in the market, or the market is not going to accept your product or the service, for whom you are going to manufacture? So always the outside view is better than the inside view. And finally, again these two scientists, Lavallo and the Kahneman, say that managers feel that if they don't fully account for the intricacies of the proposed project, managers feel that if they don't fully account for the intricacies of the proposed project, they would be derelict in their duties. They would be, indeed, the preference for the inside view over the outside view can feel almost like a moral imperative, right? So indeed, the preference for the inside view over the outside view can feel almost like a moral imperative. So it means ultimately the overall this discussion helps us to understand that always if you want to temper the over optimism, you have to look at the outside view, not the inside view. But the managers feel that they are going to derelict from their duties if they are not considering the internal view, or maybe the internal strengths of the firm and internal, say, capabilities of the firm. Internal capabilities are fine, internal strengths are fine, but if you are not taking into consideration the external factors, external view, you are over optimized, and finally that over optimism is going to create the problems for us, and finally we are going to meet an end which was not expected. So always bear in mind the advice of the Lavallo and Kahneman, that managers should always should not feel that they are derelicting in any kind of the their duties. They are performing their duties well. So they have to consideration both the views into consideration, that the inside view also and the outside view also. When they are taking into consideration the inside view, they are talking about their own strengths and capabilities of manufacturing a product and generating a service. And when they are taking the outside view, they are going to know about the market they are going to enter in. They will know about the product they are going to manufacture and they are going to serve the market with. And finally, this internal as well as the external view and its total scanning and understanding would help them to be successful in the market and to come out with the cash flows which are going to be the realistic cash flows based upon the facts, and finally the project is going to be a successful venture. So, total means the decision has to be based upon the both internal and the external view, but more emphasis has to be on the external factors on the outside view, and finally the decision should be based upon it, because the source of challenge is going to be the outside view, not the inside view. So, with this we will stop here on the estimation of the cash flows for the projects, and now in the next class we would learn about, with the help of an hypothetical example illustration, we will learn that how to calculate the cash flows and how practically work it out, and finally means we will learn about that in the normal course, means in the normal course how the cash flows are worked out for the from the perspective of the total funds or the explicit cost funds point of view. That we will learn in the subsequent class. Till then, thank you very much.